Welcome to the deep dive. You know the score. You send us your intriguing sources, and we sift through them to bring you the crucial insights fast.
Hmm,
Today, we're plunging into the world of intraday trading strategies, specifically looking at how to refine signals from the Zig Zag indicator.
right.
This deep dive is tailored for the learner, based on a compelling Hindi language YouTube video from the Easy Trading Tips channel.
Absolutely. This video, titled Zig Zag Indicator Strategy in Hindi Zig Zag Indicator Setting for Intraday Trading, is actually the second part of their explanation.
Okay.
They built a foundational strategy in a previous video, but our focus today is squarely on the filtering techniques they introduce here.
Gotcha. So the filtering is the main event for us.
Exactly. Our mission is to understand how these filters can potentially lead to more reliable and, profitable intraday trading decisions when using the zigzag indicator.
Okay, let's unpack this. Even though we don't have part one directly in front of us, the creator gives us a heartful overview of what that basic strategy likely involved.
Yeah, they do a quick recap.
It sounds like the core revolves around the zigzag indicator itself, set to its commonly used default parameters, a period of 12, a deviation of 5, and a backstep of 3.
And working alongside the zigzag, they were using the stochastic oscillator with settings of 12, 3, and 3.
Right, the stochastic.
Now, for those who might be newer to trading, the stochastic oscillator is a momentum indicator that helps us identify potential overbought or oversold conditions in the market.
Uh-huh. Helps see if things have moved too far or too fast.
Pretty much. The basic buy signal, as they described it, appears when both lines of the stochastic oscillator dip below the 80 level without actually touching each other.
That not touching part seems important.
It is. And then they cross upwards from below the 20 level. This suggests a potential shift from downward to upward momentum.
Right. And a crucial element is that this stochastic signal needs to be accompanied by a bullish reversal candlestick pattern. The video highlights the bullish engulfing pattern as the ideal signal. That's where a smaller bearish candle is completely overtaken by a larger bullish candle. But they also consider hammer or inverted hammer patterns as potential buy signals.
Yeah, a bit more flexibility there.
So that's the initial strategy. Now here's where it gets really interesting. How do we add layers of confidence to these signals? That's where these filtering techniques come into play.
Exactly. The core of the filtering introduced in the second part is about adding confluence. By confluence, we mean looking for multiple independent signals to agree, which can strengthen the conviction of a potential trade.
Makes sense. More agreement, more confidence.
Precisely. The first key filter involves drawing a horizontal line on the chart. This line is placed precisely at the low point of the bullish engulfing candlestick pattern, or whichever bullish reversal pattern triggered the initial signal.
Okay, a horizontal line at the candle limit. Why there?
This taps into the principle of support and resistance, where previous lows often act as areas of buying interest, like a floor for the price.
Okay, so we've identified a potential buy signal based on the stochastic and the candlestick, and we've drawn our horizontal line at the low of that reversal candle. What's the significance of this line as a filter?
The crucial part of this filter is observing how the zigzag indicator behaves after that initial signal appears.
After the signal. Okay.
Okay. Ideally, the first zigzag low that forms after the buy signal should touch and then be rejected by this horizontal line.
Rejected, so it bounces off it.
Exactly. This rejection suggests that the price is indeed finding support at that level we've identified, adding weight to the bullish signal. It's like the price tests that floor and bounces back up.
Got it. So it's as if the market probes that low and says, nope, not going any further down right now. That makes sense as an additional reason to believe in the signal. But the video mentions not just one, but 4 confirmations for a buy signal. Let's dig into those 4 layers.
Right. The first confirmation builds on the stochastic oscillator. While the initial signal requires that upward crossover from below 20, this first filter looks at the stochastic's recent history.
What about its history?
Ideally, the stochastic, using slightly different settings here, 12, 3, and 4 are mentioned, maybe a typo or just a slight variation,
Right.
should have been in an overbought zone before crossing down below that 80 level.
Ah, so it was already high, came down, then gave the buy signal later from the oversold area.
You got it. For those familiar, being an overbought suggests that recent buying pressure might be exhausted, making a downward crossover a potentially stronger signal of reversal before the eventual buy setup.
Okay, that adds context. Confirmation number 2 involves trend lines. Trend lines, for those tuning in, are lines drawn on a chart to connect a series of high points or low points, helping to visualize the direction of price movement.
Yep.
This sounds a bit more involved. Walk us through drawing these lines in this strategy.
There are actually two trend lines to draw in this scenario. The first connects the swing high points that occurred before the stochastic entered the oversold zone, extending towards the most recent peak identified by the Zig Zag indicator.
So, outlining the recent downtrend, basically.
Kind of, yeah. Think of it as outlining the downward pressure that might have been in place. The second trend line connects a series of recent higher low points leading up to the high that formed just before the bullish reversal signal candle.
Okay, connecting the lows leading up to the signal.
Right. And the breakout of this second upward trend line, specifically at the bottom, is considered a strong confirmation that the downward pressure might be lifting.
A breakout of that upward trend line. Interesting. And the video specifically points out that this bottom trend line breakout is particularly attractive because it often comes with a smaller risk.
That's what they claim, yeah. Meaning traders can potentially set a tighter stop-loss order. That's definitely a key consideration for managing risk.
Always important. Okay, what's the third piece of this confirmation puzzle?
The third confirmation takes us back to that horizontal line we discussed earlier, the one drawn at the low of the reversal candle.
The support line.
Exactly. This line now acts as our support confirmation. The fact that the first zigzag low after the signal candle touches and then bounces decisively off this line reinforces the idea that this is indeed a valid level where buyers are stepping in.
So, step 1, the stochastic setup. Step 2, the trend line break. Step 3, the bounce off the horizontal line. What's 4?
And the fourth confirmation, really bringing it all together, is the presence of a clear, bullish engulfing candlestick pattern itself occurring within that oversold zone identified by the stochastic.
Ah, so the quality of the initial candle pattern matters too?
Definitely. So we're looking for the stochastic to have been overbought, then crossed down, a breakout of an upward trend line drawn at the bottom, price respecting our horizontal support line, and a clear bullish reversal candle.
Wow, that's a significant amount of agreement among different indicators.
It is, and that's precisely the aim of filtering, to increase the probability of a successful trade by requiring multiple independent signals to align.
Less noise, more signal.
Hopefully.
Yeah.
The video even provides a specific example from today, which would have been May 16th, 2025, on a 15-minute time frame to illustrate this.
All right, they describe drawing those two trend lines we just talked about. One, connecting those zigzag peaks down to the high of the reversal candle and potentially preceding high, and the other connecting those recent prior highs. And then, of course, the crucial horizontal line placed at the low level of that bullish engulfing pattern.
And the key element for the filter being satisfied in that example was that the first zigzag low that formed after the buy signal did indeed touch and then bounce back up from that horizontal support line.
Confirmation bounce.
Exactly. The video highlights that this specific setup resulted in a favorable risk-reward ratio, suggesting a potential profit target that was at least twice the size of the potential loss if the trade went against them a 1.2 ratio or better.
Always good to see a focus on risk-reward. Okay, so that's the strategy for identifying potential buy trades. What about sell signals? How do we adapt these same filtering techniques when we're looking for opportunities to profit from a downward move?
The underlying logic remains consistent, but naturally, we look for the inverse signals. We'd be looking for a bearish reversal candlestick pattern, such as a shooting star.
The one with the long upper wick.
That's the one. A small body at the bottom, long upper wick appearing after the stochastic oscillator lines rise without touching below the 20 level, and then cross downwards from above the 80 level.
So coming down from overbought this time.
Right, indicating potential exhaustion of upward momentum.
And how do we draw the trend lines in this case? For a sell.
For a sell signal, we would draw a trend line connecting the series of swing low points, creating a downward sloping line that visualizes potential support that might break.
Okay, connecting the lows.
Then, similar to the buy setup, we'd connect the high point immediately before the bearish reversal signal candle to a prior swing high to establish another trend line, potentially outlining the prevailing upward momentum that might be breaking down.
All right.
A breakout below this downward sloping trend line would then act as a confirmation of the sell signal.
Breaking below the trend line confirms the sell idea. And how does the horizontal line filter apply to sell trades? Is it the high of the candle?
You got it. Just as we placed a horizontal line at the low of the bullish reversal candle for buy signals, for a sell signal, we place a horizontal line at the high point of the bearish reversal candlestick pattern.
Okay.
The filter is confirmed If the first zigzag high that forms after the sell signal touches and is then rejected by this horizontal line, indicating that the price is encountering resistance at that level.
Resistance at the candle high. Makes sense. The video also shared an example of a sell trade that was deemed invalid according to these filters. What made that particular setup a no-go?
Yeah, that was interesting. In that specific example, the price action was already trading below the downward trend line before the bearish sell signal even appeared.
Ah, so the break happened too early.
Exactly. According to the logic of this filtering strategy, that negates the purpose of waiting for a trendline breakout to confirm the signal. The breakout should ideally occur at or very close to the time the signal candle forms.
That makes sense. You want to see the signal and then the subsequent confirmation of the trend line being broken, not before.
Right. They also provided an example of a successful sell trade, referencing the Nifty index. What were the key elements that made that trade valid according to these filters?
What did that Nifty example show?
In the Nifty example, they highlighted the stochastic oscillator lines, moving upwards without touching the overbought level and then sharply crossing downwards.
Okay, the classic sell setup for the stochastic.
Yes, this was followed by the appearance of a bearish engulfing candlestick pattern. The trend line in this case was drawn from a recent zigzag high down to the low point that occurred just before the bearish signal candle, resulting in what they described as a near vertical or very steeply downward sloping line. The subsequent breakout below this trend line provided the confirmation they were looking for.
A steep trend line break. And just like with the successful buy example, the horizontal resistance confirmation played a role here as well, right? Did it touch the high?
Precisely. A horizontal line was drawn at the high of that bearish engulfing pattern, and the first zigzag high that formed after the signal touched and was rejected by this line, further strengthening the confidence in the sell signal.
Got it. Rejected from resistance.
And again, this setup led to a favorable risk-reward outcome for the trade.
Good. Now, interestingly, the video briefly mentioned another filtering technique, the concept of a break and retest. How does that idea fit into this overall strategy?
Yeah, they just touched on it. They noted that if a previous resistance level is broken by price, and then subsequently that same level acts as a support level on a pullback.
Old ceiling becomes new floor.
Exactly. That can also be considered a valid buy signal, offering another potential entry point or confirmation.
And the opposite for sells, I assume.
The same principle applies in reverse for sell signals. If a previous support level is broken and then acts as resistance on a subsequent move back up, that can offer another opportunity to sell short, break support, come back, test it as resistance, then maybe go lower.
Okay, another layer to potentially consider. And finally, they placed a significant emphasis on the visual shape of the stochastic oscillator lines leading up to the crossover. What were they looking for in that regard?
They really emphasize the importance of seeing a clear and relatively smooth movement of the stochastic lines into the overbought or oversold territory,
Smooth movement.
with the two lines remaining distinctly separate and not touching each other before the actual crossover occurs. This kind of clean separation and subsequent crossover suggests a more decisive shift in momentum and potentially a more reliable trading signal.
So messy, choppy stochastics might be less reliable, even if they cross.
That seems to be the implication, yeah. Look for clarity.
Okay, let's bring it all together. In this deep dive into the zigzag indicator filtering techniques from the Easy Trading Tips video, we've seen how it's all about building a case with multiple pieces of evidence.
Stacking confirmation.
Right. You've got the stochastic oscillator signaling potential overbought or oversold conditions with that clear shape, then a trendline breakout occurring at a significant juncture. Price action respecting horizontal support or resistance levels defined by both reversal candles and zigzag pivot points, and of course the presence of the initial bullish or bearish reversal candlestick pattern itself.
Exactly. These filtering techniques, as presented in the video, are specifically designed to help traders increase the likelihood of identifying valid trading signals generated by the zigzag indicator.
Right.
And, crucially, to potentially improve the risk-reward profile of their intraday trades. By demanding these multiple layers of agreement between different technical tools, the goal is to reduce the number of false signals.
Fewer bad trades, hopefully.
And increase the probability that a taken trade will ultimately be profitable.
So for you, the learner, and anyone else intrigued by these methods, the next logical step would be to take these concepts and explore them on your own trading charts.
Absolutely.
See how these various layers of confirmation interact in different market conditions and across different time frames. Practical application is key, isn't it?
It really is. To understanding their real-world effectiveness. And as you delve deeper, consider this. How does the discipline of requiring multiple independent technical signals to align impact your own trading psychology?
Good question.
And ultimately, your decision-making process when navigating the inherent uncertainties of the financial markets. It's not simply about aiming for more winning trades, but also about cultivating a more disciplined, thoughtful, and robust approach to how you engage with the market.